Hey guys, Slater Magic here. Haven't made a video in a while because I was really just waiting for this one to come out. It's the Q1 report for Hasbro, and this thing, I had to glance through it. It is absolutely all over the place. Oh yeah, and I'm still sick. You probably noticed. All right, so Chris Cox opens by "We're doing great." We all know that's not true. Well, that's my summary. Thanks for coming. Okay, I'll get into the details. And usually I'd just like write down notes about the gist of it, but this is so all over the place, I got to take it line by line. All right, first quarter highlights. Remember, their definition of highlights for last year was very interesting. Revenue declined 24%. There you go. That's their first highlight. But guys, that was driven primarily by the E1 film and television divestiture. That's funny. If it was making money, why did they sell it? Probably because it wasn't making money and they're lying. In my opinion, by the way, none of this is financial advice. But guys, excluding that divestiture, revenue only declined 9%. Whoa, what a highlight. I love two-part highlights where they really highlight what a highlight it is. But wait, with growth in the Wizards of the Coast and digital gaming segment of plus 7% and entertainment plus 65%. But, I mean, if it made $1 million instead of $10 million, then 65% isn't much of a recovery. You know, this is an example, just throwing numbers out there. So 65% of a tiny number, it looks like a big number until you see the number. You know what I mean? And then it goes on to say, but that's more than offset by declines in consumer products of negative 21%. So, highlights. Let's get to highlight number 2. Operating profit of $116.2 million includes $32.4 million of intangible amortization associated with E1. So in other words, they wrote off the expense early because they disposed of it mid-year, and they were still amortizing it, which means writing it off over year to year to year. So if you buy something worth like $100 million, you don't just write it off, have a giant loss for 1 year, and then have a giant profit for the next year. You can split it up and split it out over like 10 years. And then if you dispose of it, you have to do what I just said, basically. So no, that's not real income. Now, I guess they could say, okay, operating profit of 116 quote unquote includes a $32.4 million early amortization write-off thing. But that's not what's going on. That's not profit. It's a little bit less of like an expense. Like, come on. Do they really think investors are that stupid? Investors at least know what amortization looks like and what it means. Come on. So another non-highlight. Let's move on to highlight number 3. Adjusted operating profit of $148.6 million. Sure it is. So that's allegedly about $100 million higher than I believe past year is what that means. They just put PY. I can't imagine what else that would mean. And an adjusted operating margin of 19.6%, which is like 14.9% versus past year. So they definitely dug it out of a hole, but they did it by like rearranging, selling off stuff, and making the books look pretty. But like publicly, I'm not saying they're like pulling an Enron. But are Wall Street investors this stupid to just be like, oh, number go up, yay? It's not even humans, it's AI at this point. Always was. They read the article, they read the numbers, they put it together and go, oh, look at this. Let's trade before anybody else does. Okay, so their explanation for this is it's driven by a favorable business mix. So they got rid of businesses that weren't doing very well. They're not going to tell you, but they also liquidated a ton of inventory, and they spun that as a positive. It is not. Well, it depends how you look at it, but it's generally not. Supply chain productivity and reduced operating costs, also known as firing 30% of the people at the company. They even go to the next highlight. Hasbro owned inventory is down 53% versus prior year. They got rid of half of their inventory. Wow, sales must be booming. No, they put it on fire sale. That's why they're like, look at this big giant number of income from product sales. That tends to happen when you sell it for half. It was a glorified going out of business sale because nobody's buying physical toys anymore, or at least not from them. I guess nobody wants woke Barbie and like trans G.I. Joe or whatever the hell they're making. I don't know what their problem is. They go into blah, 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 diluted shares and net earnings. Again, nobody cares about that. Operating cash flow of $177.8 million. Okay, that's like a little over double the previous year. And so get this, they say it's driven by improved operating results and benefits from working capital. They literally just have money in the bank, and do they mean to imply instead of taking out loans? This is just such nonsense. They're doing terrible. They're doing better but terrible. And the last one is they paid $97.2 million in cash dividends to shareholders in the first quarter. I could have sworn that they said they weren't going to do that until like May or something, so that's unusual, but okay. It's basically a bribe to say, hey, we're still viable. We're going to pay you directly. Just cash in your pocket to hold these stocks. And it seems to be working. As much as it pains me to say it, in the last 5 days, it went from generally $55 a share to 65, so it's up like 17.21%, something in that neighborhood. Unbelievable that people are eating this up, but like a lot of businesses are doing terrible and people are looking for anything that like is, hey, number go up, arrow go up. If they still think that the company's in like a healthy area, you gotta wait for at least another quarter for all their like licensing and digital stuff to spin up. You know, they figured out that if you just license like D&D to like a movie and a game, you know, Baldur's Gate 3, and just do nothing with zero risk and just take, you know, 10, 20, 30% or whatever they charge, then you just make a ton of money. Who would have thought? Makes a lot more sense than any kind of product that they're selling, because the products that they're selling aren't selling. Now let's get into what they call the first quarter 2024 segment details, which I think is pretty much just like, here's all the bad news, because it would have been in highlights if it wasn't, even though most of the highlights were like, here's this terrible thing that happened. But, okay, consumer product segment, revenue decrease of 21%, driven by broader industry trends. In other words, they make bad products that nobody wants to buy, which is not an industry trend, except in woke industries, I guess. Oh, don't forget exited businesses and reduced closeout sales as a result of last year's inventory cleanup. Hold up, friend, you're trying to do me a bamboozle. Why would revenue decrease because of exited businesses? I mean, they're talking about probably the media company, but if they're talking about inventory, oh no, it should be the opposite. And they were like, look at all our sales, look at all of our sales, look at our... Okay, no, yeah, that's not how that works. Operating margin of negative 11.4%. There you go. There's a number for you. Ooh, stock price go up. An adjusted operating margin of negative 9.2%. Cost saving and productivity gains offset by volume declines. Yeah, you shrink your business. It does look bad. Literally the third point. I wish I was kidding. Furby continued to perform well in the quarter, supported by the launch of Furblets in December 2023. Holy crap, I'm looking that up. What fresh hell is this? Okay, so I looked them up for you so you don't have to. It's exactly what you're picturing in your head, but stupider. If that's what they're touting as their big toy sale, it's no wonder they're getting out of toy sales. So then they go on to Wizards of the Coast and digital gaming segment. There you go. Revenue increased 7%, driven by increased in licensed digital gaming revenue. Behind, you guessed it, Baldur's Gate 3 and Monopoly Go. Why those two? Because 1, they're popping off, 2, they didn't make them, and 3, Magic the Gathering's IP ain't worth crap. That's probably half of why the Netflix show got canceled like 8 times. Oh, and the movie. And that other game. And that other game. I think there was a comic book that got canceled, actually, too. So tabletop revenue increased 5%, which seems impossible, but I guess rebound from a controversy. Behind growth in... Oh, I thought they were talking about the tabletop is in, you know, D&D. They say behind growth in Magic the Gathering shipment timing to support the Outlaws of Thunder Junction release. So they're talking about sales to the distributor, which means that the consumers haven't even bought them yet. They might be actively trying to return them to the distributor because, like from the stores, because they aren't selling again. But who knows? I think all the stores and distributors under-ordered this time, so they're just saying it's timing. They want to let everybody know, full disclosure, it's because we just sold it now. So big burst of revenue right before the quarter. Oh, and then they say it's also due to a strong demand for Universes Beyond Fallout Commander set, which, yeah, who didn't see that coming? So they ain't going to strike gold twice, you know what I mean? Like, I think that'll go down. I think Magic the Gathering income's very much on the decline. Active users on Arena are down the toilet from what I've seen. They don't even publicly say what it is anymore, and I wish they were legally obligated to do that. They would find a way to fluff it, though, in my opinion. But, yeah, operating profit increased 60%. Happens when you fire 30% of the staff at Magic the Gathering. That does tend to happen. An operating profit margin of 38.8% due to higher digital licensing revenue mix of revenues and cost management. That's just code for we fired a bunch of people. We fired a bunch of people and somehow people kept playing Arena and buying crap on Monopoly Go. Wow, lucky us. Which they literally have almost zero staff behind the Baldur's Gate 3 and the Monopoly Go licensing agreement. It's like one person, and that's usually during the design phase. So... yeah. They could fire their entire company and be like, look, our operating margin went up 9 trillion%. Well, yeah. Here we go. Entertainment segment. Let's hear about that one. Revenue decline of 85% impacted by the sale of E1 film. Really? In December 2023, absent this impact, revenue grew 65%. Well, they had nothing else, but get this. Driven by the delivery of Peppa Pig content. That's right, the piggy popping off. Peppa's still in the house. So they had an operating profit somehow. I mean, does that include the sale of the segment, like the cash price of 5.8 million? I mean, that I think they sold it for 800 million. So my guess is no, compared to operating costs or loss of 8.7 million in the first quarter of 2023. They always go first to first because like you can't compare it to the Christmas quarter, of 2023. But still, adjusted operating profit. Okay, who cares about the rest of the numbers? You get the gist of it. So the 2024 company outlook. This is interesting. For the full year, the company maintains annual guidance and continues to expect. Now remember, the first quarter one, or the year-end and initial first quarter one that we already saw a couple weeks ago, very negative, very negative. It was like, we're going to continue to not make money, deal with it, but we'll pay a dividend. Like, that's literally what it said. All right, I haven't read this part yet. I wanted it to be a surprise, so okay, let's jump in. Consumer product segment revenue down 7% to 12%, with 4 points of the decline coming from business shifting to an out-license model. Why would that be a decline? You are just like raking in money from Baldur's Gate 3 and from everything else you're licensing, Monopoly Go and whatever else you got in the works. So how does that okay, you know what? Let's move on. Operating margin 4 to 6%. Who cares? WotC segment revenue down 3 to 5%. Oh, that's weird because it's up. I guess they know Fallout was a flash in the pan, and I mean they're gonna get the expenses incurred with the next printing without the income from Thunder Junctions. Like I said, timing. It's all about timing. Operating margin 38 to 40%. Yeah, that tends to happen when you fire everybody. So they're still projecting a WotC loss. Now, WotC owns D&D, and they're still making a little bit of money on the sale of BG3, because every sale they get a percentage, I would assume. Then it says pro forma entertainment segment, which I don't know what that is. Revenue down 15 million. Okay, cool, whatever. Total Hasbro EBITDA, which is earnings before IRS takes da income. Oh, pardon me, da assets. It's something like that. It's before taxes and whatever. 925 million to 1 billion. So, okay. Gross savings target to 750 million by end of year. Ooh. I doubt that means savings in the bank. That's one term I'm not familiar with. I think they mean savings and expenses compared to the previous year, maybe? Which tends to happen when you fire 30% of your staff. I really can't bring that up enough. I guess Wall Street's real happy about that, but I mean, they shouldn't be. It's where else you're going to put your money, but still, they shouldn't be. So the 2024 capital allocation priorities are invest in core business, which they're literally not doing. They're investing in taking money from licensing it to other people. But if that's their core business, return cash to shareholders through the dividend, which is going to be very expensive, but they are doing it. So they're going to pay continued dividends, in case you didn't hear that. Continue to pay down debt. That's right, they're holding a ton of debt. And progress towards leverage target. Target and leverage is like the amount you owe versus income and all this, like assets and ratios and stuff, and there's healthy amounts and they're below it. And their stock price went up just because of the direction of the company. Come on. You don't have a nosedive and pull up a little bit and then have everybody throw money at you. You're still crashing. This is so stupid. There is zero chance they turn this around. Well, unless they make 5 other license agreements that are all on par with like BG3, but that'll never happen. No way. Get ready for the G.I. Joe versus Barbie MMO made by Valve Incorporated that secretly is also Half-Life 3. Like, come on, really? Next dividend's coming in the middle of May if you really just want to light your money on fire. Remember, the amount of cash dividends paid out in just the first quarter were just short of $100 million, which I can honestly say, in my opinion, they cannot afford. That is not something, like when you're that broke and you're in that much debt, you don't pay $100 million unless you are literally bribing shareholders to keep holding your share until May 1st. I could dive way into the balance sheet that they just posted and rip it apart, but I'll just pull out a couple of highlights. Their inventory went from $713 million to $336 million. Yikes. It's both a good thing and a bad thing. It's a bad thing that they couldn't get rid of it, and it's a good thing that they got rid of it, but it's still a bad thing that their business isn't doing well. Their total assets are worth $2.5 billion. What the hell do they own? An airport? They consider, quote, goodwill to be $3.5 billion, which I could tell you what I think of that, but there's different definitions of that depending upon the context. They have $8.9 billion in liabilities, pretty much also known as debt. I mean, like liabilities could be payroll, but like long-term debt, $3.7 billion. There you go. That's literally long-term debt. They have just other liabilities of about $0.6 billion, that's all. Shareholders' equity is a mere 2.7, so they owe more money directly to lenders than the total of the shareholders' equity. And Wall Street is throwing money at this company. Wow. If your IRA is going down, this is why, because they're this damn stupid. Under costs and expenses, royalty payouts, 6.7% of their net revenues, or against their net revenues, I should say. So out of all the money that they took in, I don't know what they'd say net revenue, would be gross revenue, okay, whatever. They paid 6.7% this year, 6.9% by April 2nd, 2023. So they were not kidding on the last statement when they said that like Fallout and Lord of the Rings are really expensive to license. 5.1% of their revenue got vaporized by interest on debt, which you do not want to see if you're a stockholder. While they're also paying you a dividend that they can't afford on top of it, just saying. I mean, okay, so the interest expense was $38.5 million and they paid out about $100 million in dividends. Yeah. They're like borrowing the shareholder money at, what would they be, roughly triple the effective APR, like interest rate, as all of the actual debt they have. Yikes. Anybody dumb enough to take what I keep referring to, in my opinion, as a bribe to keep owning their stocks is an idiot. I'm not going to keep breaking down like the entire cash flow statement, but the dividends really stand out on it. Let's put it that way. $97.2 million is a big old number. Ever wonder what percentage of their money comes from Wizards of the Coast and digital gaming net revenues by category? They like to combine them together when they're really low and they want to impress people with a big number. $316.3 million is all it actually adds up to. Now that's net revenues in one quarter, but still. I mean, you multiply it by 4 roughly. It's not really how quarters work, but because Christmas is higher and stuff. But that's a pretty big number. But so is their debt. And you expect that to be the same amount when they fired 30% of their staff? They think they're going to do the same amount of work when they already can't spell any words correctly or test their cards correctly? Nah, dude. I want to see a line item for how much they're paying other companies to maintain MTGO and MTG Arena. It's probably just a couple million tops, but like, I want to see it. The only other thing scanning through the rest of this is they had 0 acquisitions, it would seem, because their acquisition-related costs were 0. So they're selling off portions of their business, firing everybody, becoming more efficient and shrinking their inventory. Okay. Licensing stuff to just collect money on other people's work. Okay. It's not all bad. It's just, would this be my first choice? It wouldn't even be in my top 100 for companies to invest in. Energy companies, come on. Anything out there involving, I'm not going to, that really would sound like financial advice. I'm not going to get into it, but there's a lot more that I would pick. So that's it. So, pretty much what I expected. They're really trying to spin it positive, but not. It's not as much of an uphill battle as it was for the fourth quarter, the Christmas quarter of 2023. That was a bloodbath. So, hey, if you enjoyed this breakdown by someone who used to be the head accountant by default of my own company, also I took accounting classes in college. Hey, leave a like, subscribe. It's not all boring stuff like this, but man, did I find this interesting. Hopefully you did too, especially if you're this far into the video. So, hey, thanks for watching, and I'll see you guys next time.